This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty, Chief Market Strategist with the Market Guys, and it is exactly 8 o'clock on the nose this Monday evening, and I'd like to welcome all of our members and our guests this evening as we analyze the markets and we go through each one of the indices, including the spiders. I'll talk a little bit more about that, and any of the option strategies that some of our members are trading. And again, for the guests, if you like to sit back and be a fly on the wall, that's okay. But if you want to ask a question, that's okay too. The only thing that I ask is when I ask for stock symbols that you wait for my cue, and then we'll start looking at those stock symbols. You could ask questions anytime relative to what I'm talking about. So in other words, if I'm starting off with the Dow Jones Industrial Average ETF, and you have a question about that, type it right in, and then I will get to it. So the format is where I'm going to go through each index, and then I'm going to take your stocks. So we have plenty of time to do that. We have 59 minutes to do that, and I think we'll get them all in. And I think it's going to be a lot of fun. When I'm looking at an index or an individual stock, you'll notice that I've changed things around just a little bit from just a few years ago, where I would only have price and volume, and then I added the stochastics, and then recently I've added the CCI. I'm debating whether or not to remove the stochastics to get more room for the price action, but I'm going back and forth with that because the CCI tends to be a little bit more accurate with forecasting reversals and generating buy and sell signals. And so with that said, I'm going to focus more on the CCI tonight so you could really understand how powerful this is as an indicator to really look for changes or signals, and especially when it comes to momentum. And what you see here is the DIA. This is the diamonds. It's the Dow Jones Industrial Average ETF, and I've left the lines that I put on from Friday. And now that we have a full trading day under our belt, under a full trading week, you could see that the markets were down just a little bit. I had forecasted that the Dow would drop from that resistance point, and we are showing a lower high, not quite a lower low, but definitely a lower high. And while the market was lower, excuse me, while the market was lower today, it did close with a green candle. Notice the volume. What I'm doing is I'm basically giving you the steps that I follow when I'm looking at a chart. I always look at price first. I look at price relative to the moving average to see if there's any wide divergences or not. I look at price to see if there's any gaps below the market, like we see here, here, and here. There are now 3 open gaps below the market. And then after I've analyzed the price and the shape of the candle, and I spend a little time looking at that, I look at the shadows and kind of soak all that in, my eye immediately goes to the volume. And you can see that today's volume was half the volume that we had from last Thursday. Remember, Friday the markets were closed. So today's volume being half of what we had on Thursday, and you could see that the CCI is still moving lower. And if I zoom in a little bit more, I think I just zoomed in too far. You'll zoom in a little bit more, you'll see that the blue line right there is now below this horizontal gray line, which is the 100 mark. The CCI has a 0 line here. Above the 0 line, it's 100, 200, signifying overbought. So anything over 100 is overbought, anything over 200 is extremely overbought. And when you get into an overbought area and then the CCI starts dropping down and crossing below 100, it's the actual line, the CCI line, crossing below the 100 that generates the sell signal. You see that? Now, the zero line, you know, when the CCI is at zero, there's no real momentum showing, you see. But the value in the CCI comes from the divergences that we see. And in order for me to show you this, let me just get some horizontal lines here. Now, I have to be careful. I don't want to save any lines on here because the these lines that I have on there right now are going to be for the next weekly market report that I put out. So I don't want to erase any of these. Now, if you could follow my cursor, and I'm going to back up even further than this. Notice, let me see if I can find one here. Here we have a high right here. You see this? We see a high, and we notice that the CCI is in an overbought condition. It crosses down below the 100 mark right here, and if you'll notice, I'll try to move up just a little bit. Notice how the CCI crosses just before, maybe a day or two before the stochastic actually gives the sell signal, which is when these two lines cross here. So it gives us an earlier buy signal, right? Now notice that this high is also showing an overbought condition on stochastics, but notice how dramatically lower the high is on the CCI. You see here, from this high to this high, see how dramatically lower that is? That's a divergence. When you know, if it was, and sometimes we'll see a higher high, I'm absolutely certain we'll be able to find one of those. A higher high on a lower high for the CCI is an extreme sign of weakness. All right, now here is a good example right here. Here is a high in February. Now let me see if I can get my line to match this. All right, now right there, you see, look down. You see the high on the CCI, it's overbought right there. Now go back up to the price. The high on the CCI is matching with the high back here. Now look at this higher high. You see the higher high right here from the end of February? Look at the CCI now. I'm going to try to keep that line matched on that high. It's a little bit hard to do that, but I'll do it. There we go. Notice the high. Look at the price action again. It's a much higher high, but notice the CCI, the high on the CCI, is lower than what we saw at the end of January. And then shortly after that, what happens to the price? It dumps, right? It really sells off pretty hard. So here we have a dramatically higher high in the price, but we have a lower high in the CCI. Now follow me here, because buy signals are also generated on the CCI as we observe the momentum of the change in the CCI, the divergence. Okay, here we go on the buy signal now. Here is a low, extreme oversold. It's almost minus 200. See the CCI? Minus 200 on this low here from October, right? Here we have a much lower low. See this low on price? But we have a much higher low on the CCI. Here we have the divergence the other way. Much lower low, much higher low on the CCI. This is an extreme buy signal here because we're showing a lower low. We're seeing the CCI cross over and above the minus 100, which not only is it reaching a higher low, but it's also giving us a buy signal. And if you notice the candle, that's a bullish engulfing pattern on that as well. So you have this is a very, very clear and powerful buy signal. Now, Of course, it's easy to look back at a chart and say, oh, I should have bought it back then. Yeah, that signal is great. And we could all do that. We could all look at a chart and say, yeah, I would have made money if I bought it on that low. But where does that leave us now? And this is gonna help some of you, especially Pat. This might help you with you're buying puts in the SPY. Look at this high here. Let me zoom in so you can see again what I'm looking at. Here is, let me draw the vertical line. Here is, right here, let me do this one. Here is an extremely overbought condition in the CCI. Try to ignore the stochastics for a bit. Only focus on the CCI. See how the reading on the CCI is extremely high at that particular point. And we see that the price is on a higher high from here. Now remember, I'm looking at this as though there is no other price action to the right of that. I'm just trying to give you a picture. If you could, in your mind's eye, erase all this activity to the right, focus on that high right there. So we see, if we were looking at this day, the market gapped up on that day, right? Gapped up, and we see a higher low, a higher high from the previous high, and we see that the CCI is in an overbought condition. Okay, overbought, right? There we go. You look just to the right, here we go with a higher high here. See that little red candle right here where my cursor is up top. See, I'm circling it up there. There's a higher high that surpasses the previous high that I highlighted, the high before that, and the high before this. So here is the higher high coming into this, first quarter of the new year, or actually second quarter of the new year. So here we have a higher high, but look at the CCI. It's a lower high. Now, fast forward to Thursday, when I did the weekly market report, here we have a higher high, which is higher than all the other highs that I've mentioned so far. And what's happening? The CCI is showing a sell signal. See, it's crossing below the 100 mark. So, sometimes it's hard to keep our opinions out of the equation. And, I don't take it personal if, some of you say, wow, you made a call lower, but it went higher. Listen, this is not my opinion that I'm giving you. What I'm giving you is the straight read. Like if I was, refereeing a lacrosse game, for instance, we know that human error always comes into play from time to time. But the refs, my son is a player, I'm a coach, sometimes you yell at the refs, and sometimes it's hard not to yell at the refs, but I got to give those guys a lot of credit, whether it be baseball, football, lacrosse, basketball, whatever. They have to keep their emotions out of that decision and basically read the play. They have to read the play, they have to know the rules, and they have to call it like they're seeing it. And that's how I look at the market. You could think of me as a price referee. How am I seeing the momentum shifting? Am I reading the signals correctly? Well, I know I'm reading the signals correctly. Whether or not the signals are going to pan out like we expect them to is another story. But right now, there is a good chance, according to the way I'm reading the diamonds, that the diamonds are going to pull back. And we still have 4 more trading days left in this week. So, we still have a lot of time here. And the markets just might pull back and wind up at the 20-period moving average or below. Right now, I'm spending a lot of time on the diamonds. Let me get rid of that line so I could draw my drawing tools. Now, I'm spending a lot of time in the diamonds, but I'm going to go through the other markets and show you the same read on the CCI. Now, the other big thing, and pay attention, Pat, is these gaps are still wide open. So remember I said at the beginning, we have an open gap down here. We have an open gap right here, which is going to be a gap fill support. We have the most recent gap here. So here we have 3 open gaps in a row, and we have yet to make an attempt to fill even the last gap left. So there's an 80% chance that all of these gaps are going to fill. It's not a guarantee, it's an 80% chance. So if I'm reading the market and I see gaps below the market, I see the CCI giving a sell signal on a negative divergence, I see the price, fairly wide and away from that moving average, and I see a volume drop, well, at least if I'm trading my own position, I am going to try to close out of any of the long positions that I have, unless or until I'm trading a stock that is showing contrary to what the market is doing. And I'm just going to throw this out there, like Netflix, for instance. The markets were lower today, but Netflix is showing increased volume on a fairly strong candle with, look at this, no shadows. I kind of just throwing this in there. It has virtually no shadows, just very small shadows. This is a powerful green candle with all momentum indicators moving up. CCI is just today moving up over overbought condition, but it could still continue a little higher, just giving it at Netflix. And there's a resistance area right here. So what are the indicators telling us, and what is the price action combined with volume telling us? Well, it's telling us that Netflix has a good chance of breaking out over resistance. That's what that's telling us. So what I did is, and for those who are trading Netflix on the option trade, I closed out of my calendar spreads today, and I'm debating whether or not, because I speculated early, so I'm waiting for confirmation of a breakout before I tell anyone else to close positions. But I'm thinking to myself, well, I have a nice profit in Netflix. I have a put spread on, I have a call spread on, I have diagonals on. I have a really nice profit. And I thought, until Netflix settles down and calms down with the volume and the breakouts and all that, let me just move to the sidelines on that. So I closed that one out, created more buying power for possibly another position, which I'll talk about, and we move on. That's how we read the chart. And I know, Pat, I'm going to answer your question a little bit earlier. You basically told me that you have puts on the SPY and you have a call on the VXX, which is volatility index. Now, you mentioned May 6th. Let me tell you, if you've read my book, or maybe you haven't, that is the number one or close to number one mistake option traders make, is they buy front month options. You will never, ever see me buy a front month option, nor will you ever hear me recommending to buy any front month option, call or put, because most of the options that people buy in the front months expire, or there's time erosion that takes place. They buy cheap options, and it's a gamble, actually. I'm not telling you can't make money, but it's a high risk position. If I'm going to buy an option and speculate, I generally go for the more expensive options long term. At least if the trade goes against me, there's things that I could do to fix it. If you buy the front month option, especially the ones that expire May 6th, and the market moves against you, there's nothing you could really do to hedge yourself or bail out of the position or morph the position or repair the position. The only thing you're going to do if it goes against you is sell it out at a loss. And sometimes people buy the cheap options because they're accepting the loss ahead of time, and they're saying, well, the most that could happen is that option goes to zero. Yeah, but that also means the most you could lose is 100% of your investment. So I don't touch those. So hopefully that helps you out. I think your direction is right, but I think your timing and your option selection is wrong. So hopefully that helps you out. All right, now let's move on to some of the other indices. I'm going to go to spiders because, let's see, there we go. I have not talked about this in a couple of weeks. Why? And I know it doesn't take much time, but I'm listening to my own recordings to make sure that I am, not repeating myself. I've just found it to be redundant. I talk about the VIX every single week. I'm constantly explaining to people that the VIX is inversely related to the S&P. The VIX, for those of you that don't know, the VIX is actually derived from the S&P options in more or less a 30-day outlook. So what that does is they calculate volatility, implied volatility, and such, and they calculate interest rates and all this. And what they do is they come up with a number which basically is a leading indicator as the option traders see it. So it's not like, okay, it's just perfectly and directly inversely related. No, it's based on a lot of emotion, time premium and such, and a lot of different factors. But my point is, if I'm talking about the VIX and every week I'm telling people it's inversely related, well, doesn't that mean if the VIX is going to go up, the S&P is going to go down? So why repeat it? However, with that said, I've had people say, hey, can you add it back in? And so I will next week, but I still think it's redundant. But I'll do it for those who trade the spiders and who trade the volatility index like Pat and some of the others do. So hopefully that'll help you out and letting you know. So let me give you my forecast now and show you what I think is going to happen for the VIX, the S&P rather. Here is a high from last September. So I'm drawing what's called a flatline resistance. Flatline is a perfect horizontal line drawn from a high that's higher than the current high and further back in time that shows an existing high that has not yet been broken. Okay, so that's a flatline resistance. Notice the stochastics turning lower. It's already crossed with a sell signal. Notice why the divergence in the CCI. This is exactly what I started off with to show you how powerful the CCI is. Notice how the price has been going higher on the S&P, but look at the highs on the CCI. So the S&P CCI has crossed with a sell signal. Therefore, I think the S&P is going to drop and possibly drop below the 20-period moving average. Now, this is more than a 5-day forecast. You see, kind of giving you some heads up. See, here, look, 1, 2, 3. Actually, I'll go backwards. 1, 2, 3, 4, 5. The distance from here to here is 5 trading days. See, in timeline, this is probably 6 to 7. What I've given you. If I forecast out, that line ends when? On April 30th. You see the end of that line. See my box, my data box that popped up? The line ends on April 30th. So this is going to be a slightly longer than a 1-week forecast, but I think that's ultimately what's going to happen. Now, further analysis shows me the S&P has a gap down here. 80% of the time, gaps fill. I'm going to draw that as a support line. Why? Because the other part of the gap equation is once it fills 80% of the time, there's an 80% chance that it'll reverse after it fills. So there's an 8% chance it'll reverse after it fills. The fill point becomes support. See that? If you look even further, there is a very minor gap down here. I'm not going to draw a horizontal line there because I don't want to clutter it up. But that is an open gap. So you have to be really careful with any long positions, especially when you see the CCI divergence like this. Because if you notice, going back again, right, here, way back when, see back here, in September and October, we had higher highs right there combined with lower highs on the CCI, negative divergence, and that's when October, November, December, we got pounded in here after the divergence showed up. Again, even the stochastics had a divergence here. I don't read stochastics too much for the divergence. I look at it more as a momentum change when in the %K, but the %K being the blue line. But you know, it doesn't do any harm in keeping them both up, but it may clutter up the chart a little bit. So if you feel like, okay, I want to clean up my chart, make it a little clearer and less data, less noise, out of the two, I would select the CCI to keep on there. Okay. All right. Now let's go to the VIX. My forecast for the VIX was that it would go up, but look what happened. It hit my target from last week. I still think the VIX target here is what we're going to reach. Momentum indications are showing bullish for the VIX still. Even though this is a red candle, we had a higher low, higher high on the VIX today, and the momentum is still showing up, which is, again, bearish for the S&P. Remember, bullish VIX inversely related is bearish for the S&P. All right, let's go to, I'm going to go to the Qs, just to kind of recap what we talked about last week. I said that we would most likely drop. Even though I said that, we are still almost perfectly at our resistance line that I drew last week from the previous highs. Dow was down, NASDAQ was up, right? Well, look at the negative divergence. The negative divergence is still holding on the CCI, so I'm still more bearish than bullish on the Qs, with gaps below here and gap below here on the Qs, the S&P, and the diamonds. Now, why is that so important that you have three major markets? Why are all three of them showing gaps below the market? It's very unusual that you have that happen. It's even more unusual that you see gaps on the Russell 2000 because it's a broader based index. You have 2,000 stocks now, and in order for the Russell 2000 to gap up, that means all 2,000 stocks that are being tracked by the Russell are going to have to gap up. So it's highly unlikely that you'll get gaps on the Russell, but sometimes you do, and those are even more significant than the Qs and the diamonds, which the diamonds hold 30 stocks. So if you're analyzing the overall market, you want to put the most weight into the Russell 2000, which I'll get to right now. Then I hop right to the VIX, and then I go to the diamonds and the S&P. Look at the Russell 2000. Again, we got mixed markets here, but my forecast was that we would go lower on the Russell, and chances are we'll do that. Indicators here still showing downward momentum, and you have a negative divergence on the CCI from last week. After we hit a higher high here, we had a lower high on the CCI. See that? So, all right, so we covered the Russell. They talk about the diamonds? Yeah, I think I start with the diamonds. Talk about the Russell, talk about the diamonds, talk about the Q, the spiders, the VIX. All right, we got those covered. I even threw in the other stock, Netflix. All right, now I want to before I start taking your stocks, I want to thank Kim. Do we have Kim online here? Let me just see the attendees. We have a lot of people on board here, so let me just see. Kim is one of our most recent mentor students, doing extremely well. Very quick study. Oh, there's Kim. Okay, I'm gonna kind of highlight to protect your privacy. I'm just gonna mention your first name. Kim is trading calendar spreads. Excuse me. And I'm walking her through how to initiate calendar spreads. So I gave her the recipe card to do that. Now, Amgen came up thanks to Kim. And what Kim did today, Kim, just give me a thumbs up or wave your hand if it's okay for me to just talk about this individual position. Just put your hand up. Click on the hand bar, and hopefully there's a little bit of a delay there. There we go. Thank you, Eric. Okay, Kim's given me permission to talk about this. So Kim took a long position in Amgen, and it's a fairly conservative position. For those who trade options, understand it is a diagonal calendar call spread. If you don't know options and you want to learn about options, and you have at least 50 grand in your account, ping me and we'll talk about maybe holding a spot in the summer session for you in the mentoring. This is an extremely conservative strategy that could wind up making extremely generous returns on investment. And you could still be wrong. I don't want this to sound crazy, but Kim is taking a long position, and the stock could still go lower, and Kim could still make money, even though it's a long position. Now, let me show you the technical signals. Let me first erase all this so that I am, let me erase all lines. Come on now, I got a little bit of a delay here. Clear drawing set. Now, remember how I analyzed the markets in the very beginning? All right, look at the why isn't there? There it is. Now, what do I say? The first thing I look at are the candles, right? Second thing I look at are the divergences or the rubber band effect from the moving average. Then I look for gaps and candle patterns and such, like, things like that. And then I look at volume. Well, let's start with the candles. 1, 2, 3, 4, 5, 6, 7, 8, 9. The news on Amgen has been negative mainly, and and you could see that we have 9 consecutive red candles in a row. We have a wide divergence from this moving average, and bam, look at that. Can you see this volume bar? What does that mean? Well, if you have less than half of the volume that we had on Thursday, less than half, and you have a small little body with a long shadow under the body, this is a hammer pattern, and you have a wide divergence from that moving average, I would say, and again, I'm going out on a limb by saying this, that there's a 99% chance tomorrow we're going to have a green candle. I know that's a high percentage, and even with 99%, you could still lose money, right? Because there's still that 1% chance that it will not go up tomorrow and show a green candle. I'm not saying it's going to go all the way up to the moving average tomorrow. I'm saying there's a 99% chance that we'll have a green candle tomorrow. Why? Because look back in the past. When was the last time you saw a long stretch of green candles like that far away from the moving average? It was back here. You see here? Let me try to zoom into that area. And again, I know I'm taking my time on this one because this is just so important that you get this, all right? Here we have 1, 2, 3, 4, and we have a green candle. I'll count that as a negative though. 1, 2, 3, 4, 5, 6, 7. This is a big stretch. And then look right down here. Can you see that? I know it's hard for some of you. Let me try to zoom in. Hold on. All right, I went the wrong way. Hold on. This is why I get so excited about this stuff. This is like, it's like almost a no-brainer how clear the signal is. See, this is a small body. This is an inverted hammer, but still a small body on low volume. See how the volume increases on the way down here? See this? And then bam, huge drop in volume, small body candle. What happened the very next day? Green candle. Now, is tomorrow going to be as green and as long? I don't know that. I really couldn't tell you how long the candle is going to be tomorrow. I'm just telling you there's a very high chance it's going to be green. So what Kim did is she anticipated the possible green candle for tomorrow, took a long position using options, hedged herself by selling calls in May, selling calls in the front month, not buying calls, Pat, selling calls to bring in money to lower the cost basis of a trade, and didn't do it big. Well, at least I hope, Kim, you didn't do it big. Tiptoeing in the market. Now, notice the price. There are going to be some equity traders that are going to say, boy, I wish I had more money to buy this one. Well, guess what? Amgen is part of the pharmaceutical, the biotech rather. What is it? BBH. There it is. Right. So, well, that's still a high price stock, but it's part. If you want to diversify a little bit, you don't want to trade Amgen, then trade the BBH. Because it's diversified in some of the biotech holders, with Amgen just happen to be one of the higher holding. Now notice the BBH, 1, 2, 3, 4, 5, 6 red candles in a row, and this is starting to turn green. With indicators down here, boom, starting to head higher, and the CCI showing an uptick here as well, you see? So if you want to trade this one, what you could do, and I would encourage you to do this if you're an equity trader and don't want to even touch options, open the prospectus, go to Yahoo Finance, open the prospectus for the BBH, look at all the holdings within that exchange traded fund and pick one of the cheaper stocks within that biotech holding, and you could still at least participate in the sector without putting a whole bunch of money concentrating in $100 or $117 stock. You see, so there's so much available to everyone as long as you know how to dissect the market and pinpoint your right, the correct positions for you. I don't want to see anyone taking extreme risk. There's no reason to have to take extreme risk in this market, especially when the signals are just that good. You see, so I just want to point those couple things out, and you can see that here. I just noticed this. Look at the BBH. Here you have a higher high on a higher reading on the CCI on this high here. Notice to the right a higher high. You see that? With a lower high than this previous high. I picked the wrong high here. Sorry. Here's the high on a high CCI, overbought CCI. Here is another high on a lower high on the CCI. There's your negative divergence there. So just before the BBH and Amgen took a nosedive, we had indications from the CCI telling us it's going lower, and then bam, here, look at that, bearish engulfing pattern. Isn't that unbelievable? So again, there's just so much opportunity out there that really anyone could pick something and make money in this. All right, let's okay, you're welcome, Pat. Thank you. And okay. Yeah, okay, so we got your question answered, Pat. I just read that real quickly. All right, so now it's time to start typing in some of your stock symbols. Let's see. Jeff says earnings coming out on the 30th. Absolutely, after the market close. See, this is the thing, Jeff. If you're an option trader, you shouldn't have to fear earnings announcements, because, give you an example, in the spread that Kim traded, let's say the earnings come out and surprise the analysts and it goes up, right? Kim is positioned for that. She'll make money on the way up. If the earnings come in as expected and the markets lay flat, okay, Kim's still going to make money on that spread. If they disappoint a little bit and the price of stock drops a little bit, Kim will still make money. If the earnings disappoint and the stock drops a lot, Kim may not make money on this day, but she can quickly adjust her position to make money another day and reposition very quickly to adjust and modify that position according to how bad the earnings were, and actually get right back into a good or even better position. So out of those four scenarios that I gave you, up, sideways, down a little bit, down big, Kim is a high probability going to make money on that spread. And that, that's why people pay me so much money to do the mentoring, because once you learn this, then you're going to take that for the rest of your life, and it becomes a money-making machine. For some people, and you can ask Kevin. Kevin wrapped up with our mentoring not too long ago. Kevin is an attorney who, in and out of court, but now Kevin, now that he knows options strategy and how to trade spreads, is Kevin on the line? I hope he is. Kevin has like a little side business going in his trading, you see, because you don't have to stare at your computer and keep it on, during the market hours. When you're trading options, or if you're a swing trader, you got the technology working in your favor. You don't have to sit there and stare at your computer. I mean, there's been times, and I told Kim this, there's been times where I've actually been riding my horse in the Cedar Key scrubs, seriously, trading the market, because I got an alert on my phone. I'm not kidding you. I got an alert on my phone. I keep it on silent because if I have an alarm, it spooks my horse. But I got the buzz, looked at my phone, pulled under a tree, got off the horse, made some trades, let the horse eat some grass, finish the trades, got back on my horse. I am not kidding you. That's how I trade. And you have so much freedom to and not be a slave to your computer and sitting in some office staring at charts. Now, there are some people, don't get me wrong, there are some people that just love getting into, the action, right? I met some folks that just have, you go into their home office and it looks like, NASA, control central with computers and monitors everywhere. Some people like that. That's cool. It's okay. It's cool. But I just like the freedom. That's all. All right. So thank you for that, Jeff. Now, Ron is CZZ. If you're going to put in a stock symbol, please do what Ron did and type in what your intentions are. Okay. We still have a lot of time left here. All right, now notice, Ron, we have a triangle. That's the first thing. Remember, I look at is the price action. All right, now I see this is a symmetrical triangle right here. You see this? So if I take these lows, connect it to that low, project out, and do that, there's the apex. This stock is most likely going to start to break out. It could break out to the upside, to the downside. We don't know yet. The breakout has not occurred. So Ron's question is, what would be a good entry point as the uptrend seems to have slowed? You're absolutely right, Ron. It's slowed, it hasn't ended, and the stock hasn't dropped below the 20-period moving average. But here's how you determine your entry point. If you're bearish on this one, or looking to take a bearish position, I would wait for it to close below the bottom triangle line and preferably down below the 20-period moving average before you take a short position. Notice that on today's red candle, after I look at the price action, where's my eye go next? Volume. Look, today's volume was pretty high. In fact, it was about 35 to 40% more volume today on that red candle than there was on Thursday. All right, so got to be really careful with that. On Wednesday, there was, is that a bearish engulfing pair? If not, that's very close to it, very close to it. And the CCI is starting to go lower. Stochastics is already going lower. Ron, I hate shorting $12 stocks, but the signals are telling me, more bearish than bullish. And at this point now, what you have to do is switch to the weekly chart to see what the weekly charts are telling us. And weekly charts are still telling us bearish. See, weekly stochastic still going lower. The weekly CCI is crossing with a sell signal. But again, I really hate to short $12 stocks. I mean, I'm sure you can find a better short than that, but be careful. If you short it, put your stop right above the upper triangle line. All right, now, Dave, looking ARRY, owns it, but it has been consolidating, want to buy more. Let's see, I'm starting off with the weekly chart on this one on ARRY. That's, again, biopharma. And, the weekly chart's not looking pretty. All right, Dave, be careful that before you start buying more. All right, the weekly chart's not looking pretty at all. Stochastics pointing lower and going lower. CCI very, very wide on the weekly CCI. Very, very wide price divergence there. Look, higher highs on much lower highs on CCI. Very high probability this one's going lower. Really be careful of that one. Now let's switch to the daily chart and see if it gives us any more clues. All right, thing that I see with the daily chart is that you could see a short-term bounce here. That doesn't mean I'm shifting my position. Okay, now I see a short-term possible bounce. That short-term bounce might only be for a couple of days. Understand, Dave, that this 20-period moving average, while the stock could recover to that point, the 20-period moving average could also act as resistance now. So be careful of that. The other thing that I notice, there is a gap way down here at around $16 for that one. And that $16 price is leaving us, right pretty much at this trend line here. So if you own it already, I would say hold off on any new buys and stand strong on protecting any profits that you have at this point. All right, that's a big one, right? It could go up over short term. Don't get me wrong, but if you're going to put a stop, I would put my stop somewhere below these lows down here, like right around 21.5. So you're giving that a $2 risk per share if you're wrong. All right, so hopefully that helped you out. All right, let's see. Next in line, John. Sold Qualcomm. That's QCOM. Let's take a look at that, John. We'll be starting up pretty soon. I don't know if we have a date set for you yet, but looks like we looked at this one already on the Fibonacci numbers, and looks like, let me erase all the lines though. Okay, so you sold out of QCOM after they won the suit against ABM, thinking of buying back in soon. Wouldn't do that. I wouldn't think about buying Qualcomm anytime soon. Here, let me give you a clean slate to look at. Analyze price, right? Boom, vertical move. There's after they settled the suit. Gapped up, huge gap, but count how many green candles there are. 1, 2, 3, 4, 5, 6 in a row, and wide divergence, gap below the market, stale green light, drop in volume, stochastics reaching overbought in a very big way, starting to go flat, and look at that. The CCI is showing lower highs, while of the last 3 trading days, Qualcomm has been showing higher highs. I don't like betting against the CCI. Don't like it. It's a very accurate indicator. It's you know, this, I don't know what your main reason is for buying more. They are a major player for 5G. That might be true, but you know what? There might be too much momentum built into the good news about them settling winning the suit against IBM. I don't feel good about buying, especially if $81, $82 stock. I'd be more inclined to do a put spread on that one, where buy the January in the money puts and sell something out of the money down here, and stick with something like that. Okay, so hopefully that helps you out, John. All right, Dylan. Now we're going at a good pace. I don't feel like we're going too fast. I think we're doing okay. All right, so Dylan is the same thing, except, same stock on Qualcomm, except Dylan has bought the July puts, long July $75 puts. Let me take a look at those for a second, Dylan. You're long July. All right, at least you didn't buy the front month. I'm okay with a little time, but with July, you don't have the luxury of turning it into a calendar spread. That's the only thing. So let's take a look. I gotta move my cursor around. All right, so the July, let's look at the July options here. So you're long the July 75 puts. Those are out of the monies. You'd be better off buying in the monies next time. Don't just buy the cheap puts. That's a mistake people make again. And if the price gap fills, you're going to be in great shape. Okay. The good news for this is number two, I don't know when you bought those and what price you bought them. They're trading for under $2 right now, but there's a good chance you're going to make money on that. The thing is, if this pulls back, it may not just fill the gap immediately. So in other words, it may not just come right back to fill the gap and bounce. It might come down, reach half the gap, fills, then it might bounce and go up before filling the rest of the gap. So just because it went straight up doesn't mean it's going to come straight down. So this might flounder a little bit. What I would say, Dylan, is because that is a cheap option that's out of the money, you're not going to have the luxury of time working in your favor. You're going to have to be quick to take your profits, although I think you have a good chance of making profits here. You can't get greedy with that one. If you bought them for 2 and you could sell them at 3 or 4, I would do that, and I wouldn't cry if it goes lower, and because the last thing you want to say is, oh, I should have held on longer. No, you can't lose money taking profits, There's always going to be another trade around the corner. Don't worry about that. Don't get greedy with it, but I think you could make some money. If the stock pulls back, like I think it will, you have to watch the volume. All right, so let me erase the line, show you exactly what I'm talking about. If you start to get red candles, all right, that start looking like this. So you get a red candle here, next thing you get a red candle here, you know, so on and so forth. It comes down here, and then you see the volume going up on those down moves. The moment you see a lower candle, doesn't matter what color it is, if the stock has been going down and then you see a dramatically lower volume candle, that would be your signal to get out, take a profit, okay? Volume is a leading indicator. Don't forget that. Now, Philip, I'm going to move right along because I'm looking, we got a good pace going, but I want to make sure we're keeping everyone in. Philip says, what's that ticker there? ISRG, ISRG, no position, looking for a stock purchase entry point. All right, well, the good news is it's going down, and it's going down vertically, all right? The bad news is you still have to be careful not to try to catch a falling knife. Remember what we talked about when I mentioned Kim's trade, right? Kim has a similar stock, right, with Amgen. Now, here you have a long stretch of red candles. 1, 2, 3, 4, 5, 6, 7, right? 7 red candles in a row. This gap is completely filled now. See this gap? Right there. It filled today. Looks like today's low actually completed the gap fill. So, analyzing price first, and we'll talk about volume second. You have a long stretch of red candles. It's a very expensive stock, so you'd have to really trade options on this if you're not already. All right, so there's a good chance the stock will show lower volume tomorrow because it's right at the gap fill point, 80% chance it'll reverse. Once the stock starts going up, you might see a little bit of a hiccup here as the gap fills. It might pull back before going like this, all right? What you have to be careful is that if the general market starts going down, this might continue to move lower in sympathy and actually might break down below that support. So you have to be very careful. Philip, I would not take any new long position until you see that drop in volume first. And then you want to really keep an eye on the CCI down here. As soon as the CCI starts going up, that's going to be an extremely positive sign. Lower volume on a positive CCI would be go for entry. Get in there and take a position. Again, I hope you're trading options. I don't see any mention of that. If you've never traded option before, I would encourage you to plug in to us and get an option class going. All right, so Ron, we already looked at CZZ, so thank you, got that one. All right, David is looking at SQ. That's square. Let's see, SQ, Square Inc. says equals engulfing pattern plus CCI and stochastics. Okay, I would totally agree. This is a bullish engulfing pattern. You got a drop in volume telling us that the sellers are losing momentum. I love it. That's bullish. Stochastics starting to move up. That's bullish. CCI starting to move up. That's bullish. Everything there looks bullish. The most recent support level that would be used for this particular trade would be from this low back here in January. I'm drawing a horizontal, what's called a flat line. It's just a straight horizontal line from the low. If you buy this one or buy options in this one, your exit strategy would be initiated on a breakout below that support, right? So bullish engulfing pattern 80% of the time it goes. Today's bullish engulfing pattern ends this stale red light. The drop in volume again supports the buy idea, and I like your idea. So if you're going to take a long position, be careful. It's still a fairly expensive stock. Don't trade in over your head. Trade comfortable and in moderation. All right. Let's see. David says, regarding your comment on Kim's position, regarding earnings. How do you account for the fact that implied volatility will drop like a rock after earnings? Well, that's usually the case. And so when prices drop, the volatility premium in an option gets sucked out. It gets sucked out of the option. And so the good thing about putting on a spread after the earnings and even after if the stock drops is that on the other side of Kim's trade, she's short an option. So if the volatility drops on her spread, the option that she sold is going to shrink very rapidly, which will put an immediate profit in her account on that side of the spread. I hope I didn't confuse that example there. But what happens is if a call spread goes against you and you're short as a partial hedge, then as soon as that stock drops and the volatility gets sucked out, there's a couple of things that you can do to bring premium back in. One is you could roll down on the short side and go out a month and collect more premium, and now lower your cost basis even further. The whole I have to be very careful because I know there's a lot of people don't know what I just said. But the beauty and I could even say the magic of a diagonal spread is that it's so flexible that even when the market moves against you, you could repair it very quickly. And we've had some positions go dramatically against us in the past, and we still came out ahead. Over time, it takes a little while to repair them, but you can repair them, right? So hopefully that helps you out, David. And David, I think you're the fellow that sent me the message on spiders, on analyzing that on the weekly market report. If you're the one, thank you very much. You brought my attention to that. Didn't answer you, but also know that I do look at my emails and they do get brought to my attention. So again, thank you. All right, Roberta, thoughts on Anthem, ANTM. All right, got my chat box right in the symbol box there. So ANTM, Anthem Inc. Well, this was, you don't own it, but my thoughts are, this is almost a mirror image of what we've seen in a couple of the other stocks, particularly Amgen, where, again, you have that long vertical sell-off here, and then you start to see the drop in the volume, which we're still seeing happen. This one looks a lot more bullish than bearish for a couple of reasons. Not only is the pivot point started to form, but you got long shadows. See that, Roberta? Underneath here, these long vertical shadows under the candle tell us the sellers tried to push it down on Wednesday and Thursday, but failed to keep it down. So when the sellers fail to keep the price down, new buyers recognize that they lost that battle, and then they start to get more brave and jump in. So today is more or less the completion of this pivot point. All right, there is a very good chance the stock is going to rally. Again, this is a highly priced stock, so if you're trading options, that would be your best bet. The momentum indicators down here, stochastics turning up, and CCI very, very close to a buy signal. If you get any kind of a green candle tomorrow, the CCI will give you a buy signal. The buy signal will occur when the blue line here crosses up and over the minus 100. See the minus 100 off on the scale to the right there? The minus 100 is the buy signal. Once the line crosses over that, you buy it. All right. All right. So hopefully that helped you out. Let's see. We've got a couple more. David, last one. We got 2 minutes left. Same for LW. Let's take a look. LW. Oh, there we go. All right, Lamb Weston Holdings. Yeah, bullish engulfing pattern. Yeah, folks, see, this is why it pays just to listen in. David, thanks to you, I'm going to put that on my watch list right there. See, watch. I'm going to go off to the left, and I'm going to put LW in there. It's not one that I've ever traded before, but it's something I will now watch and possibly trade. Thank you. So even I benefit by watching the symbols that are submitted by the audience because they help build your watch list. I would say the same thing. You got a bullish engulfing pattern, you got the indicators moving higher, you got the drop in volume, although it's very slight and hard to see. you do have a drop in volume telling us the sellers are starting to lose some of the momentum. You got a wide divergence from the 20-period moving average. If you bought this one, David, I would say get out of the 20-period moving average. That's going to be more or less a $2 to $3 rally to get back up to the moving average, and that should help you out there. Okay, John, you got the date. You're starting the mentoring on May 5th or 6th. Okay. I didn't put that in my calendar yet. I didn't get word. I will definitely mark that. For anyone else who is interested in the mentoring, our immediate sessions are full right now. So, there's no pressure at all, but we are going to be filling the classes for the summer months. This is the first time where we're booking ahead instead of having people wait too long. We're giving them, we're shortening the waiting list. Let's put it that way. So if you do have an interest in enrolling in the summer session, there are some things that you need to know to qualify. It's not going to be for everyone, but I promise you, I love teaching people how to trade options, particularly calendar spreads. It's a comfortable way to trade conservatively. It's very forgiving. You could make mistakes and still make money, and the market can move against you, and you could still repair and make things good. So with that, again, I'll be looking for any emails. If you're interested, just send me an email. Go to the Market Guys website, click on Contact Us, and those emails will be forwarded directly to me, where I will call you, have a little chat, and see where we stand on that. So with that, I went 1 minute over. Hope you're okay. The recording for this will be sent out to all members through the member page. And I am looking forward to speaking to you next month. And again, for all mentors, I'm looking forward to speaking to you later this week. Have a good one, folks. Talk to you soon. Bye-bye.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.